Equity markets are turning choppier by the day as they prepare for the US Federal Reserve's two-day monetary policy meeting. The benchmark indices, for instance, fell over 1% in the intraday trade yesterday but ended near flatline. Moreover, over the past 6 months, the S&P BSE Sensex and the Nifty 50 have slipped around 5% on the bourses amid expectations of rate hikes by global central banks due to the ongoing Russia-Ukraine war and historically high inflation. Against this backdrop, all eyes are on the US Fed meeting, which begins later today. The outcome might result in a 50 basis point rate hike in the world's biggest economy, its biggest hike since 2000. Moreover, it could also be the first time in 16 years that the US Fed officials will hike borrowing costs at 2 consecutive meetings. Analysts expect the US Central Bank to announce plans to start shrinking its near $9 trillion bond portfolio at a likely pace of $95 billion a month. If so, that would be nearly twice as fast as the previous time officials delved into trimming the money supply in 2017.
See, markets have definitely priced in 50 basis point rate hike. So, I think as long as it is 50 basis points, so that is already priced in. See, as far as US market is concerned, whatever we have seen in last 2 weeks, I think bond markets have been pretty much volatile and they are already pricing in steeper hikes. But I'm not sure about how the Indian markets have been pricing it in. So there could be some mispricing as far as Indian market is concerned.
Concurring with Solanki, Dhananjay Sinha of JM Financial believes that riskier asset classes could be in for a volatile phase as they haven't priced in elevated rates yet.
I think what the market would be looking for is whether the hawkishness that Fed has actually adopted recently, is it going to be far more aggressive than what is known. I think that's what the market would be looking forward to. I think the likelihood of a higher rate hikes or a higher or a steeper balance sheet tapering is fairly high. It is already known that Fed has agreed to a 50 basis point hike and a $95 billion kind of balance sheet rundown. I think what is not known is the implication of that on the asset price in the financial markets across fixed income, equities, commodities, real estate, etc. So this is going to have a permeating effect on multiple assets. So that is yet to pan out. As of now, we are seeing high volatility with respect to fixed income. So I think there is good amount of pricing that has happened in the bond market, whereas with respect to equity markets, it's still fairly shallow and I would say fairly modest. So it's quite likely that as the normalization pans out, it's the impact of that on risk assets can be seen.
So, how should investors position themselves in such a market? According to analysts, markets could see a knee-jerk reaction on the downside if there is a 75 BPS rate hike in May or faster than expected hikes throughout 2022. In the long term, domestic markets may resume their uptrend. Jyotivardhan Jaipuria of Valentis Advisors points out that the US Fed hiked rates 17 times by 25 BPS each in the 2004 to 2006 cycle. During the period, Nifty went up 99.1%, though Dow Jones went up only 7.2%. During the 2015 cycle, the US Fed hiked rates by 2.25% when the Nifty went up by 40.1% and Dow Jones rose 31.4%. Given this, analysts say investors should use periods of volatility to gradually increase allocation to equities to benefit from healthy earnings growth that can unfold over the next 2 to 3 years. Apart from the US Fed's meeting, developments around rising COVID-19 cases in China and the Ukraine-Russia war will be tracked by global markets today. Back home, domestic markets are shut on Tuesday on account of Eid ul-Fitr.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.